Coming up on Market to Market, Washington rallies its forces to fight opioid abuse. More farmers are fuming over dicamba's drift. And global climate change gets extreme for the administration. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, August 11 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The price of doing business in rural America declined slightly last month, which is good if you're making a purchase or two on Main Street, but not so great for the economy as a whole. The Consumer Price Index fell 0.1% in July as food at the local diner and the gas to get there remained relatively flat. The same was true for the index without food and fuel. The annual inflation rate is 1.9%, enough to stay away from the R word, but not enough for the feds to raise interest rates. In rural America, response times for police, fire, or EMS can be long ones. When a loved one has overdosed on opioids, the wait can feel like an eternity. Hundreds die every day across the nation from opioid abuse. Those in Washington see prevention, treatment, and overdose response as 3 goals for the nation. John Torpy has the details.
The opioid abuse epidemic gripping the country had President Trump's full attention this week as he took time out of his vacation to meet with the group tasked with solving the problem.
Nobody is safe from this epidemic that threatens young and old, rich and poor, urban and rural communities. Everybody is threatened.
According to the president's Opioid Drug and Abuse Commission, the problem claims 30,000 people annually. Late in the week, he honored a request by the commission and verbally declared the problem a national emergency. The president plans to draw up documents formalizing the pronouncement in the near future.
Strong law enforcement is absolutely vital to having a drug-free society. I have had the opportunity to hear from many on the front lines of the opioid epidemic, and I'm confident that by working with our healthcare and law enforcement experts, we will fight this deadly epidemic, and the United States will win.
After the commission met with the president, Health and Human Services Secretary Tom Price laid out the next steps.
The president is absolutely committed to solving that problem, and we are going to turn over every single rock and make certain that we're identifying every single thing that could move us in a better direction.
For Market to Market, I'm John Torpy.
Monsanto designed the Extend system so row crop farmers could deal with weeds tolerant to chemicals like glyphosate. A special formulation of dicamba completes the prescription. However, dicamba has been known to be volatile and, under certain conditions, may move off target, causing crop damage in nearby fields. Monsanto is not the only company with a dicamba-based weed-fighting tool. Among them is DuPont, which is the parent company of DuPont Pioneer, which helps fund the production of Market to Market. Colleen Bradford-Krantz has the details.
Patty DeZeo, a crop insurance agent and rancher in Brookings, South Dakota, got the first calls about 2 weeks ago. Farmers reported cupped soybean leaves similar to those noted in other U.S. fields as suspected dicamba damage. One farmer was as distraught as she's seen in 2 decades of selling crop insurance. DeZeo had to tell him what he likely already knew. Crop insurance typically only covers losses due to acts of nature. The farmer faces potential losses on 500 acres of beans after dicamba allegedly drifted onto his land from a nearby field. The South Dakota Department of Agriculture has received hundreds of similar reports since early July, far more than the typical 50-some herbicide drift complaints reported most years. In some cases, state officials suspect the wind picked up in a day or two after application and pushed the herbicide vapor elsewhere. They are confident most commercial applicators and farmers in their area were following label directions. Producers in at least 10 Midwestern and Southeastern states have reported problems they associate with dicamba. Arkansas and Missouri both banned post-emergent use of dicamba, but Missouri ended the ban after putting stricter label requirements in place. In June, a group of Arkansas farmers filed a class action lawsuit against, among others, Monsanto, which sells Xtend soybean and cotton seeds that are tolerant to dicamba. DuPont and BASF also sell EPA-approved dicamba products for post-emergent use. Monsanto officials said in a letter posted online for growers, "We have also heard reports that some farmers are noticing signs of leaf cupping in nearby soybean fields, which could be attributable to dicamba. Anytime we hear reports of potential crop injury from any cause, it concerns us." The EPA, which is investigating, recently issued a compliance advisory reminding producers it is unlawful to apply any other dicamba products during the growing season other than the 3 approved for such use. Others can only be applied for off-season weed burn-down use. For Market to Market, I'm Colleen Bradford-Krantz.
The drought gripping the nation has intensified in the Dakotas, Nebraska, and Iowa, where combined 38% of the country's corn is grown. The root cause of increasing temperatures remains a bone of contention for the Trump administration, and the official definition is a bit of a moving target. Paul Yeager explains.
The United States may already be feeling the impact of climate change, according to a report drafted by scientists from 13 government agencies. The New York Times obtained a copy of the document in which some scientists felt compelled to call out huge differences in past research and current administration beliefs. At least one scientist said directly the Trump administration will try to suppress the research. However, at least 4 of the scientists interviewed said they don't have specific examples to support the claim. The report says extreme heat waves have become more common and extreme cold spells less common since the 1980s. The leaked documents reveal that, in the lower 48, the annual average temperature has already climbed 1.18 degrees warmer over the last 30 years. Also stated was that the heating trend would continue if carbon pollution stays at current levels, translating into a 4.83 degree increase by mid-century. Even how climate change is referred to is getting a makeover, as a series of emails obtained from inside the USDA's Natural Resources Conservation Service reveals a change in language from climate change to weather extremes. The exact cause of the rise in temperature is part of an ongoing debate, as the president denies emissions of greenhouse gases are the basis of increases, claiming global warming is a hoax. The president has touted reviving America's struggling coal mines and new oil pipelines as ways to bring jobs back to America. Federal scientists counter that burning those fossil fuels are driving the run-up in temperatures. For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Federal government data kicked the legs out from under struggling prices as Thursday's report pressured the grain markets lower. For the week, September wheat fell 16 cents and the nearby corn contract moved 6 cents lower. The report made for a 30-cent drop on Thursday for nearby soybeans, but the September contract clawed its way back to suffer only a 14-cent loss by the final session. December meal lost $5.20 per ton. In the South, December cotton shrank $2.37 per hundredweight. Over in the dairy parlor, September Class 3 milk futures rose 35 cents. Livestock had a mixed week as the October cattle contract dropped $6.70 and nearby feeders plummeted $8.62. The October lean hog contract bumped up $1.85. In the currency markets, the U.S. dollar index declined 46 points. Crude oil lost 76 cents per barrel. COMEX gold poured on $29.40 per ounce, And the Goldman Sachs Commodity Index continued its decline, dropping just over 1 basis point to finish the week at 382.60. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Thanks, Mike.
In case you want to go over things again, you can listen to our Market Analysis and Market Plus podcast anytime online at iptv.org/MTOM. Naomi, not a great way to finish the week with Thursday's USDA reports coming out. I want to kick it right off here with a question from one of our followers on Facebook. We encourage all of you to send us questions on Facebook and or Twitter. This comes from Tyler in Foreman, North Dakota. He says, between dicamba dinged soybeans, which we touched on earlier, and Thursday's report, where is the bright spot of the week for the American corn, soy, and wheat grower?
That is a great question because that report sure was something.
It was.
Wasn't it?
It was.
Here's the bright spot, is that demand overall is hanging in there. And so if you look at the soybean market in particular, what you saw there as far as the bright spot was the USDA cutting old crop ending stocks substantially. The truth finally comes out. Takes months, but it comes. And so with that being said, they increased the demand for exports. And so you have a strongly led demand export market. Demand is fantastic for corn, soybeans, and wheat, and that is your bright spot. So in regards to that report and the yield numbers that were produced, be patient, they'll come down.
Okay, we'll just need combines to start rolling.
Unfortunately, yes.
All right. Well, in this wheat market, Naomi, one of the numbers, if I believe it's correct, USDA predicted a spring wheat crop of 400 million bushels. Is that correct?
Yeah, right about in that area. They didn't do too much with the wheat numbers at all. And so the overall, the all wheat numbers for yield and production came down just a little bit. And the ending stocks came down just a little bit. Trade was expecting and hoping for more, and so that's why the market had reacted so negatively.
All right.
Going forward, of course, with the spring wheat, we'll see the abandoned acres numbers come up, but that'll be, post-harvest rally type of a thing. But that'll be the next piece of the puzzle that we need to receive yet.
If we do start to get a post-harvest rally as we get to understand the true spring wheat acres, do you anticipate Chicago, Kansas City contracts tagging along if we can get any amount of excitement built in wheat?
Well, I think so. It'll be how much of a rally depends on the numbers that we receive for the spring wheat. But in general, by then, we should see a seasonal post-harvest rally bounce from corn and soybeans anyway. So
Okay.
I would say that all three will move. It's just in the short term now we're stuck with a little bit more of a sideways to lower range. But, with these markets, it was important that they were able to show resiliency on Friday's trade and finish where they are. That was, to me, a big, yeah, we don't buy this type of a thing.
And that is a great way to segue into corn. USDA came out. The trade was anticipating 165, 166 for a national average corn yield. USDA came out, I believe, with 169.4, which, Naomi, you talk to growers all across the country. That would give us our third highest crop in history, third largest crop in history, excuse me. Is that what you're hearing from growers?
No.
Are they growing their third best crop ever?
No, they're not.
No.
They're not. So again, we have to be patient and the truth will come. But on this report, the USDA, in terms of ear weight, used the third largest on record, and in terms of ears per acre, it was the fifth largest on record. So unfortunately, the reality is going to come because when you talk to the producers out there, even the places where it's good, they're not saying it's as good as last year, and they're really saying it maybe is going to be their particular 5-year average, but it is not the same conversation as a year ago.
You bet.
At all.
Now, one of the things that you mentioned was we broke down out of the range on corn yesterday. We were down at 371 and change. And then today, Friday, the market did rebound. We pushed it back up. We came very close to that 375 mark. What do you expect to see come Monday with this bounce back to the upside on Friday?
I'm very curious to see what Sunday night's trade is and Monday's trade. If we can keep the market still sitting in that 375 area, then what will happen is that we continue then to be in our 9-month trading range. And that's a huge success. That is the market saying, no way, USDA, we know the yield's not there. So if, though, for some reason, the market decides to trade the USDA report instead, and then the funds who had started to build a long position, if they decide, let's just take care of the seasonal sell-off and push things lower, unfortunately, the technical slide could be as much as 30 cents to the downside. So Sunday night, Monday, Tuesday trade is so important next week, and if we can just keep in the range, we'll call that a victory.
Okay. Soybeans. Naomi, same story. We went from the trade anticipating, and even USDA in July anticipating 48 bushels per acre to 49.5 bushels per acre. National average soybean yield. Now, of course, we're just getting into August, but we did see that market respond rather aggressively on Thursday. Was the bounce back on Friday, did it confirm as much for you in beans as it did in corn?
The corn was a bigger victory for the soybean number. I think we're all on the same opinion that yield really potentially could come in just at the trend line area at 48.
Okay.
And so we have to get through, obviously, this month yet to see where the yield could end up and the crop tour is coming up. That 49.5 number is something else. And if we can see the soybean market for the November price, if we can see it, if when you step back and look at the range that it has been in for the year, $9 is a support level. $9 is a tremendous support level. I think we'll hold that. We'll stay there. I'm really hopeful that the market can, in general, stay back more in the 940 area, which is where we are right now. But again, if the funds decide to do any selling off, we could see it slide a little bit lower. But in the end, once the combines get going, we will see a post-harvest bounce.
All right. And you talk about that 9 being a support level. We did have a forecast come out. And of course, these change every 6 hours. Cooler temps, more rain. All of those things could help induce those funds to start to move back more aggressively into a short position.
Right. But at the same time, the demand is so strong and the exports are fantastic for soybeans. And, you know, who did you see today buy grain? China.
Yes.
So, hey, they took advantage of the market being on sale. So good little
60,000 metric tons.
Yeah. Oh, yeah. They
So do you
up.
think we're just starting to see them come in? I mean, China, they've got 50% of the world's feed grain stocks. Why are they buying 60,000 metric tons of corn, Naomi?
Well, they're buying the grain because they need it. They need it for blending. They need it for keeping things fresh. And it's on sale. So you bet they're going to step in and buy.
So at these price levels, we could see induced demand since it's kind of a fire sale going on, especially in beans.
Yes.
All right, Naomi, well, now let's talk livestock. And since you are our native Wisconsinian, I want to turn to your thoughts on the dairy market. We've seen a lot of volatility. I mean, it seems we're down 40 cents, up 35 cents, but that $17 on the front month has been a tough nut to crack. Are we going to get there anytime soon?
I think we stay in a market that continues to be in a range where we're going to continue to see the price mechanisms that we've been seeing. The demand is good. Demand hasn't been the issue at all. We have a lot of milk out there. You know, production, the most recent production report was again up over 1 percentage point. And exports are okay, and the cheese demand, you know, as soon as the cheese gets cheaper, then all of a sudden people come in and they do a lot of buying. And so the whole system of the dairy market right now seems to be in one big kind of sideways chopping trading range. I think you see that to continue because there's, again, demand is fantastic and it's offsetting the supply. So we're going to just be stuck here for a little while.
So we either need to see demand become overwhelming to move prices higher, or we need to see some herds cull aggressively or production slow down.
Yeah, and I don't think you'll see that with the cooler temperatures that are out there right now and with feed being cheaper. I think you see production stay strong.
Production's going to stay. Now, there was a deal where EU signed a bilateral trade agreement with Japan, locked in some geographic indicators limiting how other parties can sell Parmesan cheese or, you know, Camembert, or I don't know, all my cheeses. Long term, do you see that being a detriment to U.S. dairy producers, those kind of agreements?
I'm not sure is the answer. And there's a lot of trade agreements that are going to be thrown around in the next coming months. So I don't know that one in particular is going to stand out one way or the other.
Gotcha. Now let's take a look at the livestock market. We saw a big pullback on live and feeder cattle this week. Saw a big break yesterday while corn was completely falling apart. Naomi, when you look at the live cattle market, what's your general tone here looking forward? Are we putting in a low, or do we still have more downside ahead of us?
With the fat cattle market, I really think that it probably can go just a touch lower yet. With the October's technically going for a target of 104 on the charts, so we're almost there. The long-term uptrend had been broken last week or the week before, and the issue is that we've got placements coming, huge numbers coming. Production is so strong right now. And again, cooler temperatures, cheap feed, you're going to see that continue. But demand is fantastic. Our cumulative exports for beef right now are up 6% from year-ago levels. So demand is fantastic. It's just that we've got a lot of supply coming. And so with the setback that's coming and with the potentially just a little bit lower we can go, then I think you see the brakes go on pretty strong.
Okay.
And then we go into a new sideways range. It's going to be lower than where we were, but then we have to get back to a point of deciding if demand can keep up with the current extra production. And we have to actually make sure that the production is as large as what they're thinking it's going to be.
You bet. And I would imagine we could be entering a situation like 2015 where cheap corn, lower priced live cattle, and cooler temperatures all might induce additional feeding, and we don't want to go back to seeing a situation with heavy carcass weights.
Right.
Okay. Feeder cattle, big break on Thursday as corn was dropping by 15 cents. Feeder cattle also fell apart. What's the thought behind that, Naomi?
I think it was more technical selling and chart-based selling than anything.
Okay.
I really think that's the only thing that was going along with it. The downside target on the October feeder market, so the 140 area is about where we are. We could go down to 135. And then, just like the fats, then we'll start to trade sideways. We got to see really what's out there. And demand will keep up. I really think it will. So it's a friendly story.
That is exciting to hear about export demand being so strong for beef. And of course, now we've got China at least opened up a crack maybe to grow into the future. Japan has been a very, very strong buyer, and U.S. consumers have been stepping up, willing to put beef on the grill.
Very much.
Now, we also are in a situation this fall, well, fourth quarter 2017, we're starting to see the doors swing open to a lot of these new pork processing facilities. So those hogs are coming online. It looks like that's fairly well priced into the market. But Naomi, what are your concerns with this hog market? Do we have some more downside risk to prices here?
Maybe is the answer. We're all trying to get a grasp on the potential production that's coming.
Okay.
And so maybe is the answer, but right now we're not sure. And you hit the nail on the head. We've priced in the extra production that's coming. That's why the deferred contracts are so much lower than the front month contract. A huge 20-point difference, and that's substantial. But you know what the front month is telling us is that the demand is fantastic right now. People are eating pork, and our exports they go back and forth between where we're exporting 1 out of 4 hogs or we're exporting 1 out of 5 hogs. Right now we're back on we're exporting 1 out of 5. So our demand has set back a little bit in terms of exports, but you know what, it's good overall. And I don't see any tremendous sell-off for the hog market anytime soon, but I don't see a reason for those deferreds to rally either.
Okay, that was my next question. For producers who are wanting to do some risk management, at these price levels in the fourth quarter, first quarter 2018, do you want to go ahead and get some locked in?
If you can find a way that it's profitable, I think I would be doing something.
Okay.
Because we all know the production is coming, the larger numbers are coming. So as long as demand stays good, you're probably not going to see any tremendous sell-off, but at the same time, risk management's important.
Yes, it is, because something can always come out of the blue.
Right.
Naomi Blohm, thank you so much for taking the time to join us. That wraps up the broadcast portion of Market to Market. However, Naomi and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. Now, Market to Market may be airing in different time slots due to fundraising on PBS. So if you find value in our program, please consider making an investment in a service that provides you with the news and market analysis you've come to know and trust. Join us again next week as we look at how young veterinarians are stepping up in remote regions of rural America. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.